Hey, welcome to the Army Roundtable. Today's the 15th of June, 2022. Welcome. We have Scott Ruble from Stratagem Trade. Known Scott for quite a while, went to one of his events. He's a stand-up kind of guy. I really like Scott. I grew up in Chicago. Scott's in Chicago, and Scott's a pilot. I'm a pilot. So we have a lot of overlap, and it's always a good time we get together. So, Scott, I'm really happy to have you back. And we had some questions about option pricing and spreads and SPX and stuff, and I know you have some great insights on that. So I asked you to come and do a little talk about that. So welcome, and we look forward to hearing what you say.
Thanks, Tom. And no, you're a pilot. I just sort of muddle around.
Oh,
So you're a real pilot. So anyhow, thanks for the introduction, and let's get started. Today's topic is going to be pricing options and spreads. I'm going to be using the SPX as the example, but it works the same way in everything. And I have a lot of students at my company that are always frustrated by the brokers platforms that give a mid price, especially when the markets are moving around quickly. It's hard to gauge what the mid price really is, or if that number is even a real number. You'll see vertical spreads go for a $10 debit and then a $3 credit all in a minute. What's the real price? And Tom brought up that a lot of his people were having the same issue. So we came up with today's topic of being how to price it. But before we go any further, Tom's disclaimer is not on my slides, but go to his website and agree to all his disclaimers. Mine just says I'm giving out education, not advice. And don't listen to anything I have to say because I'm a moron. So that's basically
I wouldn't go that far.
Well, that's what the attorneys make you say. So,
Well, I guess if you say that, then nobody can hold you harmless,
right. Well,
yeah.
and I've got an ex-wife that'll agree to it. So,
Me too.
But I want to thank Tom for all his help. He's always been great.
Hey, love that T-38.
I remember what you flew. So it was hard finding a T-38,
It was a beautiful airplane.
I want to know. The closest thing I've came to that is I flew an Albatross once. So, which is like a ghetto Russian Czech type thing. But
Sure.
Anyhow, for those who don't know who I am or what Stratagem is, I'll give you a quick introduction. We're just an education company. All the traders, all the instructors, I should say, were traders in one of the various pits on the floor or are fund managers. I personally spent time in both the bond futures pits at the Board of Trade, the S&P 500 futures and options pit at the Chicago Mercantile Exchange, which is the top right corner, and in the S&P 100 and 500 options pit on the CBOE floor, which is primarily where I spent most of my time. What you see at the bottom is the OEX, which is now the SPX. The SPX is so big that they took over the OEX pit. But I was also a lead instructor at Trade Secrets. I was in charge of the speakers at Optionetics. I owned Random Walk with a partner, and partnership dissolved, so I started Stratagem. Mostly we're known for the BWB because I introduced that strategy to the world, but also now we're becoming more famous for actually volatility pair trading. And I've been doing a lot of teaching of this in Europe and Northwestern University. That being said, let's get going. And this is one of the most important topics that my students bring to me. And Tom said he has a lot of students questioning how to price a vertical spread, especially when the market's going nuts, especially when your broker's platform is giving all kinds of different prices. And those who become really reliant on looking at the mid price of a spread that the broker trading platform disseminates the price to, often jumps all over the place and you don't know what the real number is. So one of the most important topics is, what is the right price of any option or spread? You don't want to trust that that $2 number you're seeing on the screen is right when you can really buy it at 150, because you know you're going to be overpaying. Or just as frustrating is, it says $2. You're like, $2, I want to close out my trade at $2. That would be great because I think I'm going to lose more. So you put in $2 and it never fills. So I just came up with this based on yesterday's closing prices, and so everything's relevant. Let's say you want to go out and buy the 37.40, 37.45 call spread in the SPX. Your broker's platform comes up with a mid price of, say, $2.90. How do they derive that number? Is that even a real number? Most of my students, until they've heard this speech twice, 3 times, think that the broker's telling them where the spread's really at, and it's not it at all. Okay, the broker screen may say it's got a $2.90 mid price, but it usually isn't even in the ballpark of what the trade is really going for. And I'll explain why and how to get around it throughout the rest of the session. But the price you see is simply the average of the two numbers a dumb robot calculates as just an average price. For example, here you see that the numbers of the 40 call is 46.60 bid, 48.20 ask, and the 37.45 calls bid is 43.70, 45.30 ask. So all the platform is doing is coming up with an average. Just like you learned in basic options when you were first starting to learn what an option or spread was, calculating the bid ask of a spread just is simply making those crosses, where if I bought the ask and sold the bid on one side and then bought the ask and sold the bid on the other side, what is the middle ground? And here you see that if you buy the ask on the 40 call and sell the bid on the 45 call, you're going to get a 450 ask. And when you do the reverse, which is sell the bid at the 40 call and buy the ask of the 45 call, it's a 130 bid. So the widest bid ask spread you could come up with is $1.30 bid at 450 ask. Now, all the software is doing is saying, where's the middle of this? It's essentially just saying 450 plus 130 divided by 2 is 290. And you see that 290 is represented by the mid price. And you can actually even see in the bottom of the screen where the 450 ask is called the natural, because naturally the broker's going to get a commission if you buy. You cannot miss that one. So that is all the platform's doing. It has no insight into what's really going on in the marketplace, where the spread's really priced at, or if those numbers are even real. Like we've seen the last month in this tremendous volatility and jumping around of markets, where the S&P's averaging more than 100-point range every day. It takes a while to update all these different strikes in the SPX. And once in a while, somebody will come in and try to sell, say, the 40 call at a cheaper price, and they reflect that on the screen. So let's say you're looking at that 40 call that's trading 46.60, 48.20, and someone wants to sell it at 47. We know the bid is 46.60. They can just slam it and for sure be filled at 46.60. But they're going to try to split the market and save a little bit, what's going to happen is the ask price is going to go from 48.20 down to 47, and it's going to change the average of the spread just because the number has moved. An artificial number has moved. And once in a while, one strike will be updated, but other strikes haven't been updated. You guys all know how fast the SPX can move. We can go through several strikes in seconds, and it's hard to keep all these strikes updated, especially when we're going extremely fast. And so often, or more often than not, that number is not even real. It may be in the ballpark, but it's not actually where the spread's trading at. So not only is the bid-ask spread 320 wide on this, okay, the difference between 130 and 450, which is wider than the price of the spread. Think about that. If the spread's really worth 290 and you gave up the natural to get in and out, you're going to be giving up more bid-ask getting in and out than the spread's really worth. So obviously people are going to try to shave down the price a little bit. But not only that, but if one or more of the option strikes are not priced correctly, all the information that the system set up to just come up with an average price for is coming up with average prices of bogus numbers. And when the markets are crazy and you're wanting to either take advantage of the opportunity of buying a bottom or getting rid of a long put spread you bought way before the market fell and you want to get the profit and get out before we bounce, or you're just got a bad trade on it and you want to close it out because you're at your stop loss, it's very difficult and emotionally to put in an order that the machine is saying should fill at and nothing happens. And then you move it down 10 cents and nothing happens. And you move it down another 10 cents and nothing happens. And then another 10 cents. And you're like, well, what's the real price? And it causes a very large amount of stress for some traders. And it's just the nature of a computer. Okay, when people were running things, it was a little bit more efficient. The computers had their strengths and their disadvantages. And one of the disadvantages is you really are having problems of knowing where the market's really at. So how do we get around that? Okay, well, when the market, let's just take a look at this. Right now, you're looking at the same option chain I was looking at prior. I just cleaned it up a little bit. And you still see that the 37.40, 45 call spread is now at 295. What is the right price of the spread? Okay, not knowing it becomes frustrating. The information at best is useless. And as I said before, at worst, convinces you to overpay when you're buying or sell too low. And let's say you put in an order for 190 or 290 because that's the mid price, but it's really trading at 145. You're going to be giving up a lot of, unnecessary money. I guarantee you, if you were trying to sell your house for $500,000 and somebody came in and was looking at the house to purchase it and they didn't know you were offering it at 500,000, they heard a rumor that you were offering at 600. You don't know where the rumor came from, but they came in and said, you know what, 600 seems like a fair price. We'll take it for 600,000. I guarantee you, most people aren't going to say, no. You know what? We were thinking about selling it at 500,000. We'll take 500,000. You don't need to give us 600,000. You'll take the 600,000, consider it like the luckiest day of your life. And that's how the traders on the floor will be if you decide to pay $1.90 for a spread that's really worth $1.45. The only way you're ever going to get it cheaper is if there's a resting order that you don't see in the system somewhere to sell it at a cheaper price. So what causes these swings from a real option price where that mid price is reliable to where it's useless? And I already touched on it a little bit, but it's these options don't all update simultaneously. Now, there is a thing when the Chicago Board of Options disseminates information out to the world, and the Option Clearing Corporation disseminates information out to the world, there are so many strikes in the SPX that a lot of the strikes are updated on something called auto quote, where it knows where the S&P future is. It assigns a delta to each option strike and will adjust the price of each option strike as the futures move to keep things more up to date than human beings can. Okay, because there's hundreds and hundreds of strikes in the SPX. It takes a long time to update them. And the minute you update them, the futures moved again and they need to be updated again. So auto quote keeps some of these up, but auto quote can also be overridden. For example, let's say we're looking at this 3740 strike. We see that it's 4660 bid, 4820 ask. And as I brought up previously, let's say someone comes in and wants to split the markets. They own the 3740 call and they want to sell it out. They don't want to just slam the 4660 bid. They're going to try to get a little bit better of a sale price. What's going to happen? What's going to happen is, let's say they come in and they're going to start offering the price of the 3740 call down. Let's say they try selling it at 48, then 4760. You're going to see the price on that screen reflect the new offer price. Finally, they go down to 4740. You don't think anything of it, but what's going on in the background is that the mid prices of the spreads that other people are looking at have just changed. Somebody who's looking at the 37, 40, 45 call spread is going to see that the mid price of the spreads changed. Why? Well, the new ask has gone from 4820 to 4740. So when you price out the bid ask of that spread now, we're using different numbers. And now we're going to see that the price of the spread has gone from 130 bid to 450 and 450 ask to 80-cent bid, 370 ask. So the mid price of the spread has gone from 290 to 2.25, even though futures may not have moved. All that's changed is someone came in and tried splitting the market on the 3740 call, and it's moved the mid price of the spread dramatically. Futures may not have moved, volatility hasn't moved, nothing's changed. Just somebody came in, tried to sell something, and now the mid price has moved 65 cents on a $5 spread. That's huge. And this is going on with all the different options throughout a chain, throughout the day, especially as the markets are going nuts. So what is the solution? That's the point. Okay, half of the battle with my students has been just to remind them that natural point, that natural price you see on the screen isn't real, because it's so easy. You want to trust that number. When it says 290, you're hoping that's the mid price, because you don't have to do any work. Otherwise, you got to go and add and subtract, and it's very frustrating for people. On the trading floor, I'm an old man, okay? I'm in my mid-50s. So when I was on the trading floor, there was no computers. When Tom and I were learning to fly, they didn't have GPS. We were navigating off of radios, VORs. And technology's made things a lot easier, but it's also added confusion along the way. On the trading floors, without any computers doing anything, I just got used to doing addition and subtraction all day long. It's not fun, but you just get used to doing it. All of a sudden, computers are going to do it for you. Why not rely on it if they're giving out accurate information? I can't trust that they're giving out accurate information, especially when the markets are going nuts. So here's the solution around it. If you can't trust the numbers around it, you got to come up with a way of verifying before you put the numbers in. And I'm going to show you a couple real quick secrets that are going to get you real close to being in the ballpark a lot more accurately than that mid price you see on your broker screen. Now, there's a lot of different ways of doing it. There's some that are very, very accurate, but they're very complicated, and it'll take me 2 or 3 hours to teach it to you. But nobody's got time for that, especially when the markets are as crazy as they are now. So I'm just going to go over the down and dirty, nitty gritty, within 10 cents of being right way of doing things. If I overpay for 10 cents in these kind of markets, I'm not happy about it, but it's not going to kill me. I'm trying to prevent a catastrophe where I'm overpaying 50, 60 cents, $1, because the screen says one thing, I trust it, I hit the send button, and next thing I know, I overpaid. So here's how we do it in terms of the easy way. The first thing you always have to do when you're pricing out an option or a spread, it works for both, and the individual option or a vertical spread works under the same process. You have to remember that everything with option trading works based on statistics and probabilities, and so it falls under a normal distribution curve. And when you're looking at a futures or a stock or an options normal distribution curve, it doesn't matter. They all work the same way. When you're at the apex of that curve, theoretically, there's a 50-50 chance that something at the top of the hill, a ball, will roll down to the left, which is the market declining, or to the right, which is the market advancing. If we use calls on the right side of this curve and puts on the left side, what I'm saying is I'm only going to deal with at the money and out of the money spreads. In other words, let's say the market's at 3,800 and that black line at the mean of this curve is 3,800. Anything below SPX 3,800, I'm only going to be dealing with put spread pricing. And anything to the right of 30 or higher than 3,800 is just going to be call spreads. And given the fact that the normal distribution curve, when we're at the money, when we're at 3,800, is a 50-50 chance of going up higher than 3,800 or lower than 3,800 over the long run. The first at the money spread is essentially a 50-50 chance of being in the money or out of the money at expiration. If we buy, say, the 3,800, 3,805 call spread, $5 wide, when the market's at 3,800, essentially it's a 50-50 chance over the long run that the thing's going to close in the money or out of the money. And if it's a $5 spread, what would you pay for something that's got a 50-50 chance of being in or out of the money at expiration? What's a fair price? Okay, think about that for a second. If I were to flip a coin and heads, I pay you $1. Tails, you pay me $1. What's going to happen over the long run? Nothing. The only thing that's going to happen over the long run is we get a sore thumb, because half the time it's going to land on heads, half the time it's going to land on tails. I give you $1, you give me $1 back. So if you're using a $5 spread that's got a 50-50 chance, the $5 spread should be worth about how much? About $2.50. So what you'll see, and this is going to be a little bit off because of skew in the indexes, but just go with this argument for a second. The at-the-money spreads should be trading for $2.50, and as we go further and further out of the money, they get cheaper. That's what it looks like with the puts. And whoops, I hit the button one too many times. And this is the calls. And you guys are probably almost all familiar with this, but you don't really think about it on a day-to-day basis, especially when you're pricing out options. Now, somebody did in the chat window talk about auto jumping, where market makers are allowed to jump in front of the customer's orders. And that's not what I'm talking about here. And the SEC is actually trying to correct that to make it a level playing field. We'll see if they actually pull it off or not. But I'm not talking about jumping. When I'm talking about bad pricing, it's not because of market makers jumping in front of us to buy something. I'm just talking about bad prices on the screen, and that's it. And there are a lot of bad prices on the screen. Okay. Now, once you remember that everything's working under the normal distribution curve and that both sides are symmetrical, it's a gradual move from 250 to 0, especially in the SPX, because the distance between every strike in the SPX is very small on a percentage basis. $5 on a $3,800 index is nothing. If you divide 5 by 3,800, what do you come up with? You come up with about 1.25%. So the distance between every strike is unbelievably small. And so there's a big, long, gradual move in the SPX in terms of option pricing of spreads, starting from at the money, going all the way out of the money. So first of all, with my students, what I've done is taught them a little trick that's been learned by standing in the SPX for decades and not wanting to go bid and ask, not wanting to have to go, what's 46.60 minus 45.30, and what's 43.70 minus 48.20. Now that's 130 bid at 450. Now, if I add the two together, that comes out to be 580 divided by 2 is 290. Okay, now I got to come up with a market that on a spread worth 290 that I can get a little bit of edge on. So now I can tell the customer 270 bid at 310 on the spread. When a broker asks me for a market on the 45 call spread, I can say 270, 310 after all that calculation. It just takes too long. We're always looking for shortcuts. What I've taught my students is all you do is look at the ask prices. It's a lot simpler, and it's going to give you the same number almost all the time. If you just subtract the two ask prices of the 37.40 and 45 spread, you're going to see it came up with the same 290. 48.20 minus 45.30 is 290. Without having to go back and forth and doing the stuff that we learned the first day we were learning options, we saved a lot of time. Now that I can do in my head real fast. So given this so far, let's say we're looking at the 37.20 15 put spread, and we don't trust one of the options. We don't trust the price of the 37.20 or the 37.15 spread. Excuse me, not spread, option. I want to buy the 2015 put spread, but I think one of these option prices is off. And you've always seen, you guys have seen that when the market's really going crazy, sometimes you'll see one strike. You can buy a lower strike call on the screen cheaper than where the higher strike call is. Meaning you can buy a call spread for a credit. Now, you know you're not going to buy a call spread for a credit, that something's wrong, and it fixes in a second. But let's say you're a market maker and this is all you have because you don't trust the price on the 20 or the 15 strike. What's the spread worth? Well, Thinkorswim or any other broker will come up with a price based on whatever numbers on the screen. And we already learned that that number may not even be real. So how would I come up with the price? As a market maker without computers, someone comes in and says, what's the market on this spread? I've got to come up and give them a two-sided market. One of the shortcuts every market maker used in their head was working off of that curve I just showed you. For example, on the call side, just going off the asks, you're going to see the vertical spreads have a gradual decline in price the further you go out of the money. The 37.40 45 call spread is trading for 260. The 45.50 is trading for 260. And you're going to see this. Okay, in theoretical world, we shouldn't have 260, 260, then 250, 250, and then 240. It should be a gradual decline. Now, either one of the prices is off a little bit, or the other factor that's going on here is when we have options that are trading for $70, they're not going to be trading in nickels. So you're not going to see 260 to 255 to 250 to 245 when going off the mid price. But that's not even the point. The point I'm trying to make here is you're going to see a gradual decrease. Here, let me see if I can remember how to work the tools. Okay.
You got the annotate?
Yes, sir. I'm just
All
looking
right.
for the right button. Oh, here we go. I'll just do draw. That'll be close enough. So you would expect this to be maybe 255 and then 245. That's not going to happen. That's it, and it's not even important. The important thing is what you're seeing is on one half of the normal distribution curve, the call side, we're just getting a gradual decrease. It's not chunking down. So it helps pricing out the 85.90 by knowing what the 75.80, the 80.85, the 90.95 is. What are the spreads around it? Now, if I'm looking at the put side, you can interpolate roughly what that 20-15 put spread's worth just by knowing what all the other options or the other spreads are worth. When I was on the floor, every morning we would go through something called opening rotation. By hand, we had to open up every single option in every single month with the broker coming up from the exchange and saying, what is the market on the 10 put? What's the market on the 05 put? What's the market on the 3700 put? What's the market on the 95 put? And we had to make a two-sided market on every single option. It was called opening rotation. Some of you guys may remember it would take 10, 15 minutes before you could start trading options in the morning because they were going through opening rotation. And there's a rhythm to how guys like me would be assigned. Okay, Scott, you've got all the out of the money puts in June 21 expiration. Doug, you got all the out of money calls. Tom, you got all the in the money calls. And we divide it up and just get through it as fast as we can. And we literally just go 6170 to 6310, 5950 to 6070, 5730 to 5850, etc., all the way down when doing the puts to open up all the strikes as fast as we can so we can start trading. A real simple way for you to interpolate this, even if you don't see the price of the 3720 15 or the 3750, excuse me, even if you don't have the 3720 or the 3715 puts prices on your screen, or you suspect they're bad numbers because you see like the price of 130 up there, you can interpolate what that spread's worth. And it's worth obviously about $2.05. So when Thinkorswim's saying 290, and if you put in an order to buy that put spread because you're afraid we're falling at 290, you may get filled at 290. Hopefully someone's trying to sell the spread at 220 and you get filled at 220 and you only overpay by 15 cents, but you're running the real risk of getting filled at 290. The machine doesn't know a real number from a fake number. So one of the tools we use is this. Now, you looking at the real numbers, you're going to see it says 210. I would interpolate and say 205 because that's between 2 and 210, but they don't have nickel increments on options this big. So this also works on very, very complex trades. Not only just a vertical spread, but the same process works on condors. We do a lot of BWBs. On expiration week, when I was on the trading floor, BWBs were my bread and butter. I would make half of my income for the month just on expiration day. And we only had expirations once a month. So literally the 2 days of leading up to expiration would be half of my month's profits because I was doing BWBs in such large quantities. And I felt really comfortable doing them.
So BWB must be bread with butter.
Well, I had a different acronym for it, but I don't know if I can share it right now. I'll share it in private. Gotcha. But yeah, I mean, it was in the clean version. All you needed was a fat man and a tree, and you had Christmas. Because the way BWBs work and the time decay, and if you're standing in the pit and you can close it down fast if bad information comes out, you're not going to get stuck, and you just sit there and let the time decay, and hopefully the market just gravitates slowly towards your strikes. There were like it was beautiful. I lived and died for BWBs, and between the BWB and pair trades between the SPX and the OEX, that was a great living. And the problem with the BWB is now you're dealing with 3 strikes. Okay, so instead of the possibility of one option being mispriced with a vertical spread on a BWB, maybe one of the strikes is mispriced, but now you're using 3 strikes. The more strikes you're using, the greater probability that one of those strikes is giving out a bad price. And it's not, BWBs do not move that much. If you got them priced right, the day before expiration, they shouldn't move that much. Even if the SPX moves 20, 30 points, it should only move a nickel. But the way the markets have been moving so dramatically of late, you mentioned some of your students were coming up and saying this thing's going from $1 debit to $2 credit and it's not a direct quote, but I'm not quoting you verbatim, but the price of the spread was moving so dramatically it's not even funny. And I know last week when we were going through these strikes like butter, I wasn't even looking at the mid price on the broker's platform because it would just frustrate me. I would see, I was looking, I'd type up a vertical spread and just out of the corner of my eye glance and see that I could buy this vertical spread for a $2 credit. Now, as much as tempting as it is to say, you know what, hit the send button, I'd love to buy this vertical spread for a $2 credit. You're not going to get filled, and the platform won't even let you take it. It'll say it's a bad price. You can't buy a butterfly for a credit. You can't buy a vertical spread for a credit. No one's going to sell you anything and give you money. But it's that number would be there, and you're like, God, if only if it were real. So the more strikes you're using, the more chances that one of those strikes are going to be mispriced. And you may see a BWB that is priced at 0 and it's worth 0. The strike separation may be $20 by $25 with a day to go to expiration, should be trading for 0. And yet the thing's going around 70-cent debit, 20-cent bid. None of those prices are real, because now you have 3 strikes where one of them could be mispriced a little bit. Or sometimes instead of doing a BWB, what I'll do is turn it into an unbalanced condor, which is essentially the same thing as a BWB. You're just elongating it a little bit. Now you're dealing with 4 strikes. Now there's a much greater chance that when you're dealing with 4 strikes, one of the strikes is going to be mispriced. So the great thing is this also works with complex trades, and I've been doing a lot of that because we're teaching a class in July 16th and 17th, a 2-day mini class called Alchemy, where I'm showing you exit plans for a very complicated trade or a not so complicated trade that has risk and how to clean it up real fast. And because our students are doing a lot of BWBs and unbalanced condors, well, you look at it and then you look at the risk graph and you see that on the tail, you could lose $5 and people panic, especially in markets like this. And their natural reaction is just to close it down. But sometimes there's a better thing to do. And alchemy is just simply taking lead and trying to make gold. And that's what we're doing with this. We're trying to take an unbalanced condor or a broken wing butterfly that's starting to scare us because the market's moving too much. And instead of closing it down, turning it into a position that looks like gold. For example, here's a regular butterfly. We did this one on Monday, just practice leading up to the class, in our pot class. We've been doing a lot of practice examples to get people ready for the July 16, 17 class. And here's just a regular butterfly I threw up. I didn't want to own the butterfly, but I just said, look, with 1 day to go to expiration and a center strike of 3,800, where we keep going back to 3,800, maybe this butterfly is a cheap bet. But all of a sudden the market's starting to sell off and we're getting down to 3,750 and expiration is approaching in a couple hours. There's a real chance we could lose our 370 debit. Even one contract's $370. You don't want to give that up, but yet you will still have a hunch we could close at 3,800. What do you do? And So we would take it and sell a condor inside of the strikes. And on Monday, we sold this, took in 420. So we took in 50-cent credit and was left with the residual butterfly at 3,800 for a 50-cent credit. Instead of closing out a trade, we thought, you know what? This thing may not work out anymore. I want to get out of it. We took all our risk off the table in terms of premium. We actually put some money in our pocket and we're left with a free trade. That's alchemy. You know, and another example I'll give you real quick, and then we'll go back to the lesson because it is applicable to what I was just talking about with BWBs and unbalanced condors. Now we're dealing with 4 different strikes where one of the options may be mispriced. And here's a BW or an unbalanced put condor we put on a while ago when the market started falling hard. And we put it on for even, and it's got a huge range. You got to love this trade. It costs us nothing. If the market goes up and the thing goes out worthless, who cares? Okay, you're bearish and the market goes up. It's not like you bought a put spread and this put spread goes out worthless. That hurts. Here, if this goes out worthless, it costs you commissions. That's it. The downside is we're having the SPX go through 100, 150 point ranges in a day. And we had this thing on, and then about an hour or two later, the market's down 60, then down 70, then down to 80. And people, my students are, you know, sending me texts and updates on Slack saying, you know, Scott, if we go through 3,900, this thing could get ugly. You know, we're going to end up with losing money on the day because it does have risk to the downside, just like a BWB. I said, don't worry. And I was 20 minutes goes by and I have 5 or 6, 7 people panicking saying, Scott, I'm getting really uncomfortable with the downside. Should I just close out this trade, pay 10, 20 cents, take a 20-cent loss and get out of it? I said, no, we'll clean it up. Okay, we'll trade inside of these strikes. We'll do an alchemy trade and I'll clean it up. And had we done nothing, we closed below 3,900 that day, we would have lost 2,500 bucks. Instead, I sold a spread inside the spread, and we ended up with essentially a trade that had a baby credit and left us with 2 little baby condors. That's alchemy. Instead of closing out something and being done, we'll get a residual free shot on it. But going back to what I was saying, we do a lot of these trades. Now, if we're doing a BWB or even just a vertical spread, it's still 2 strikes. Even a naked option, it may be a wrong price. That's even more dangerous. Because if the option on the screen is mispriced by $2 and you're only doing a single option and you don't catch that, hey, this doesn't look right, I'd rather pay 30 cents too much on a spread than $2 too much on a naked option. But now you're doing it with BWBs at 3 strikes, unbalanced condors with 4 strikes, iron condors, whatever kind of trade you like. It gets a little bit complicated. So what a lot of my students will be doing is, we're very spreadsheet proficient, is they just create a spreadsheet on Excel and hook it up to the broker that updates real time, and they can put in whatever parameters they want. You'll see that right here. Let me get the pen. You see, we just go through this gradual decline. When you're looking at the whole chain of spreads, and this one was set up where here's the bid on the puts, the ask, and this is a $5 wide spread. But you'll see this gradual move. Now, what you'll also see when you set it up this way is a freak like this. We're not going to see a vertical spread trading for $3.40 that's surrounded by a spread that's trading for $2.60 and $2.10. That means something's been mispriced at the 41.70 or the 41.65 strike. And that pops out. But you'll see most of the time, you see this gradual move. So throughout the day, sometimes you'll see this one spread will go to $2 when everything around it's 110 to 120. You know something's been mispriced. But I have a lot of students that are BWB traders or Condor traders, and they just put in one column that's 20 by $25 BWBs, and you know, it'll just they'll write the Excel spreadsheet to just show the price of every BWB throughout the chain, and they're watching it that way all day long. Okay, now somebody's sending me, I can't, a text. I'm getting a lot of text coming in. I'm just,
I guess there's a ninja spread link.
oh, you know,
Yeah.
I know Tom Sosnoff. I stood next to him in the pits for years. When he started Thinkorswim, I was doing classes with Trade Secrets. We would be in Vegas every single month together doing a class for 5 years. Okay, I know Tom very, very well. I love the guy. He's a great guy. He's hilarious. If you ever want someone to hang out with in Vegas, Tom is your guy. But I'm going to disagree with him on this one. Okay. Yeah, the bid ask is tighter in the SPY as opposed to, well, let me back up because some of the people aren't reading this. Somebody wrote, and he spoke to Tom Sosnoff at one of the sessions, and he specifically trades SPY instead of SPX because of the tighter bid ask spreads. Well, not really. When you factor in the fact that you have to trade 10 times as much to equal one SPX spread, you're giving up the same bid ask. You're also paying more commissions, which benefits a guy who owns or used to own 2 different brokerage firms. I've got nothing against SPYs. I really don't like the SPYs for new traders because even though they're smaller and in terms of dollar size, and they do have a tight bid ask, one problem is on expiration day, if you don't close out the trade, Thinkorswim or whoever your broker is will close out the in the money spreads because it's not cash settled. Okay, just like the QQQs, they'll close it out. Yesterday I had on a QQQ trade. I forgot. There was just one contract. I screwed something up, spread it off, forgot about it, didn't close it out. It was a put spread. It was deep in the money. It was worth $1 because it expired deep in the money. But right on the bell, they sold it out at 66 cents. A $1 spread, 66 cents. They gave away 1/3 of the profits just to get me out because they didn't, anything that settles into a future stock like that, they'll close out on you. And I don't want stuff closed out on me against my will because there's no way a broker is going to do a good job at it. They call them brokers for a reason. They make you broker. So I have nothing against Tom. I love Tom. I have nothing against the SPY. But I think the SPX one contract is safer to new people because of the cash settlement than the SPY is with 10 contracts. and you got all these different little indexes that are great. But if you don't close it out and the broker closes it out for you on expiration day, you're never going to sell a $1 spread, no matter how deep in the money it is, near $1. They closed out one trade of mine where I was short a spread that went all the way against me. I lost everything on it. It was a little $2 spread in the QQQ. And they paid like $2.20 to buy back. I would have been screaming. I would have done anything in the world to sell that thing at 2 on the close, or 201 for the free dollar. And yet they're paying 220. I didn't even see it go. I do not currently use Tasty Trade. I've got it downloaded. I've played with it. When I was teaching a class the last time in Italy, Tom popped on and was teaching my students in Italy how to use the Tasty Trade platform. Tom's always been very generous with his time with me and my students, and I like the platform, but most of my current students are on Thinkorswim, and so I use Thinkorswim to teach, because then my students don't have to learn a new platform. But Tasty Trades is very similar, and if you're one of these people that trades options a month out in time and close it down the week of expiration, because some people don't want stuff on expiration week, the SPYs and stuff are fine. QQQs are fine. I'm not criticizing them. I'm just saying it's one more variable that a new student has to watch. And if you forget about it, it's just painful. I hate giving away money. I hate being long a spread that I make $1 on, and they're just giving away free money to all the market makers to close me out. And it's almost unethical. There's no reason you sell a $1 spread that's guaranteed to be $1 forever at 66 cents and then charge me a commission for that privilege. But it's a personal gripe I've got that I'm not gonna rant about, but it's one of the reasons why I prefer the SPX. I mean, the SPY bid ask is tighter, but you got to trade 10 times as much, and there goes your bid ask spreads. If you give up 20 cents in the SPY 10 times, that's $2 in the SPX one time. But let's get back. I just saw a whole bunch of questions coming in. I didn't want to ignore anybody and not have their questions answered. But a lot of people have used platforms that, there's trading sites like someone mentioned, ninjaspread.com. Some of my students just make their own spreadsheets to reflect whatever personal trades that they're looking at that day, and it'll hook up real time. I mean, I can show you one right now for those who aren't familiar with it. But here, you'll see, here's one spreadsheet. You'll see it's updating as the market's moving. Okay. Now, I'm not a big spreadsheet guy because I just got on the trading floors before there was any technology. But I'm trying to figure out how to get rid of this. Oh, here we go. But if you like spreadsheets, use them, and it will help keep you where you're not going to get caught with a mispriced option. Here is, as I was stating earlier, a real good example where a mispriced option just jumps right out at you. Something is mispriced. There's no reason. You don't see that even flow on the puts on the normal distribution curve. There's a hiccup. And you'll notice it with the spreadsheets. Whatever's easier for you guys. Okay, you have to go with whatever works for you and whatever you feel comfortable with. I know a lot of people hate doing the addition and subtraction. And so maybe the 15 minutes it takes to create a new spreadsheet once a week as new expiration cycles or new strike prices come in makes sense to you. Me, I don't use it. I go, for the most part, back to what I was showing you earlier, which is this. I think this is this. I just take the two asks and separate them. Instead of doing the big addition and subtraction between the bid and ask of two different strikes, just ask, subtraction gives me the same price almost every single time. And then I look at the strike above and the strike below, and it tells me if I'm in the ballpark. Here, you can see that this spread is trading for 3. $280. And so the spread I'm looking at in the middle of 290 is probably pretty close to being fairly priced. So a question came up: is something is mispriced? Is that an opportunity for a better fill or just an anomaly? You're never going to get filled. Okay. The only time it is an opportunity to get a better fill is in a situation where I was talking about earlier, where a seller and you just happen to match up. And let me see which slide that was at. Right here. Let's say you're trying to buy the 3740 call, and you're looking at it, you're watching it, and you see the minis are moving back and forth, and you want to buy it right before the minis start jumping higher. Okay, you're bullish. You want to buy the call before the market goes up any further, and then all of a sudden you see this. All of a sudden you see, boom, 4740. Someone is offering to sell that call out. They think we've gone up as high as we're going to, and we're about to turn lower. And so they're trying to sell out their call and split the market. You'll notice because the mid price of the spread went from 290 to 235. And then you look and you see the ask price went from 48.20 to 47.40. It went down 80 cents. Well, that's when you can jump in and buy that call for 47.40 real quick, as opposed to paying 48.20, which is the ask price. In that case, you'll get a better fill. But most of the time, especially with spreads, when the thing goes from a 290 debit to a different price, like a $2 debit, and nothing's really changed, it's a bogus number. And you're not going to be able to buy a bogus number. No one's going to honor that. Just because the screen says it's worth $2, no one's going to say, well, I feel bad. This guy over in Topeka thought he could buy it for $2. It's worth $2.90, but he's upset because he thought he could buy it for $2 because the screen said $2 for a second. I don't want to see him with hurt feelings, so I'll just sell him what he wants at $2. Okay, now here. For example, I know I created this slide. I'll say, and just pass the alchemy trades. No, I don't know where it went. Oh, here we go. So for example, to answer the question again, when you see, watch the arrow. Have you ever seen that in Thinkorswim, even though nothing's going on, or whoever your broker is? You're not going to sit there and just, like a slot machine, click on the lowest one. You see it go down to 50 cents, click on it and buy it just because it says it there. You'll never get filled. It's not opportunity. It's just a bogus number. And that's it. And that's the point of today's slides. The takeaway is you're going to see stuff like this happen all the time. You can't trust it. It's going to hurt your feelings. It's going to hurt financially if you trust those numbers and wait for it to come back again. It's you've got to know on your own where the real price is when the price of the screen is wrong. And the way to do it is just simply, what I do is take the difference between the asks, look at the options surrounding it. Okay. If I'm looking at the 40-45 call spread, spread's worth 290. Going off of this, and just take 48.20 minus 45.30, it's 290. Okay. Then I look at the spread above it, spread below it, couple spreads around it on each side. If I've got spreadsheets, I can see the whole chain like this and get a real good feel where every single spread is. And it's going to, something like this is going to prevent me from ever making a big mistake. I may overpay by 10 cents or sell too low by 10 cents, but I'm not going to be off $1, which is very easy to do in these crazy markets. And that's it. Now, there's a lot more to it. I could do a 3, 4, 5 hour class on the right way to spread it, but this is just the Reader's Digest version that's pretty much good for almost everyone's purposes. Okay. If you're trading hundreds and hundreds of contracts where 10 cents is going to make a big difference on every single trade, you know, maybe you want to learn the more sophisticated way, but this is, I'm happy with this. 10 cents on 10 contracts is $100, and it's a lot of money over the long run, but in these kind of markets, it's no big deal compared to overpaying by 60, 70 cents. Now, also, if you guys want these slides, I'll be happy to send them to you. Just contact us, or we'll send them to Tom and he can send them out to you.
Okay. Yeah, just send them to me and I'll put them in our library and people don't have to bug you for it.
Okay. Whatever you want, Tom. Whatever is easier for you. Any other questions? Okay. Any other questions?
So I saw that that link for that alchemy class. Is that the same early bird price you get on your website, or? Yeah.
Well, if I want to do a commercial break, okay, it's $499 for 2 days. It's going to be Saturday for 4 hours from 8 to noon on Chicago time, Sunday 8 to noon Chicago time. We give a $100 discount for early bird registration, and we also always give Air Mirror people an extra 5% off. And in addition to that, we always give, as a bonus, because Tom's been so good to us, anybody who wants a free month of our pot class, which is weekly classes on Wednesdays, usually at night. Today we're doing it during the Fed meeting because we're going to fade the Fed move, but most of the time it's 7 o'clock Central Time for 2 hours, and people follow my trades for the whole month and get updates of what I'm doing, why I'm doing, etc. We charge $299 a month for that. You get a free month of that also. And that's just, this is like, we occasionally give deals to people, but no one gets a better deal than Tom, because we love you, Tom.
Oh, likewise.
You're such an, you're like in this industry, people with huge integrity, is tough to find, and you're the epitome of integrity. And so I always love talking to you, and I always love, dealing with you. And there's everything you say you're going to do, you do. So if you guys want to check out our be in our alchemy class, it's going to be limited to 100 people only. It's first come, first serve. You can contact our office for more information. We'll send you the flyer.
Is there a promo code? Because you said there's an extra 5% discount.
Yeah, this code right here is going to be a link. The code wasn't up, but I know my office is working on it. It should be up by the end of the day. But there's
so
a
if you use
link.
that link, it'll put the code in.
Yeah, it might not even be up yet. You know, we were dealing with this at 3 in the morning.
Oh yeah, I know how that goes.
This is Glenda. No codes needed as long as you use that link.
Okay, because it doesn't have the 5% baked in. It looks like it's just the same regular early bird
I just
price.
updated it, so you can go ahead and use that link.
Okay,
Nice to hear you, Glenda.
Hello, everyone.
Okay, this is my right-hand man. Right-hand girl. She's the brains behind the operation, not me. But okay, yeah, everybody gets the extra 5% discount and a month of free pot. And you guys met Glenda, so if you have any problems, just contact her office, and Glenda or Paulo or one of the girls will handle it for you. And yes, the alchemy classes are recorded. I know some people, like on that, it's tough coming up with the time because half of my students are in Europe. So it's hard to find a time that people in Hawaii and people in Europe can all meet. So a lot of my students just listen to the recording. The recording's up. You're going to have access to the recording for a year. You're going to have all the slides. And I'm actually having a bonus session on the following Monday where I'm going to actually do an alchemy trade for you guys. So I'll throw a trade up on Monday and then spread it off on Monday and show you how to take all the risk out without taking the trade off, you know, without closing the trade down, but so you have a residual position for free. So essentially, if you have any questions, just contact Glenda or our office. I don't know too many of the details. I handle all this stuff. I just work. Any other questions?
Doesn't sound like it.
Am I teaching any spiked collars in the classes? Yes. Not in this particular class, but we're going to have a spiked collar class towards the end of the year before we go to Maui in January for our in-person class. I actually became kind of known in this industry because of my original book, The Broken Wing Butterfly. And then my second book was on collars. And the next thing I know, I'm being asked to speak everywhere. And I've been at money shows and, you know, speaking in front of 2,000 people at a time. And it all originated from the BWB and the collars. Now, the spike collars, I'm putting the final touches on the second version of the book because it's a much more aggressive way of handling collars other than just slamming a put on and a call on and rolling it every month. But hopefully we had that before the Maui class in January. And when it comes out, it'll be up on our website and anyone in our database will get an email about it.
And my two favorite books are your Advanced Risk Reversals and Rolling Thunder. Those are awesome. If people don't have that, they should definitely get it.
You know what? With inflation, we were thinking about raising prices. I've never raised prices because, you know, originally we had the same prices as 2008. And that's like, okay, well, I'm not going to raise prices. And when the whole world's like collapsing, I said, as soon as the economy gets back to normal, then we'll raise prices.
It could take 10 years now.
And just when we're about to raise prices, the whole world's getting squeezed at the gas pumps and at the grocery store. I'm like, I'm not going to squeeze people too. Okay. I don't need the money. You know, raising our prices would just mean more profit for me. We're a profitable company. I'm not going to squeeze people. If they're having, I'm going to make things as affordable as possible and not play with these prices like most education firms that I've been associated with in the past that I didn't own were more worried about their P&L than their students' education. And it's a company. They got to worry about P&L, and the education industry is expensive to run. I mean, I spend $100,000 setting up a workshop in Maui before anyone signs up, but I don't need any more money. When the whole world's making money, inflation is 0, then I'll take my share of the pie.
Hey, Scott, I have one question. Are you guys doing any 0 DTE trades? I know there's quite a few people talking about those.
Not right now. Right now, I have, it was kind of like this alchemy class came about by serendipity. Okay, we were doing a lot of BWBs and unbalanced trades, and then all of a sudden these markets started getting crazy, and people, not just to the downside, but when we bounce, we've had days where the SPX is up 100 points. So there's no place on the graph that's without risk of actually being hit. And so I'd put on a trade and everybody starts sweating just because of the magnitude of ranges we've had. And people are like, I think this will work out. I trust you, Scott, but I just can't take watching this anymore. Should I just close it out? And so better than closing it out, let's just adjust it. So we take all the money off the table, all the risk off the table, and you're left with at least a $10 wide butterfly for free. And I did it a couple times, and then people were like, wow, I got to learn how to do this. And so I had a couple pod classes on alchemy, but there's a limit to how much you can do in a 90-minute class. And if you do them 1 week and then the next week and then the next week, there's an attrition of memory of what you learned the previous week. And so for me to go through soup and nuts and do a great job on it, I really need 8 hours in a row of your time. And I'd need a mini class, and people just out of nowhere start clamoring the office for a mini class. And that's how the alchemy class in July was, created. I mean, it was just the students begging for it. I mean, I was like, I'll teach it to you in chunks the best I can in pod class, and you don't have to pay anything. They're like, I'll pay the $400. I don't care. This will save me $400 on one trade. And that's how the class came about. So we're sort of focusing on that, and we're focusing on right now in this market, just the trading these giant ranges safely in the appropriate way of managing your positions. And then we'll go into, some of the more exotic stuff like you're talking about.
All right. Well, I signed up. I love Scott's work and support him, and he's a great teacher. And if you haven't signed up yet, definitely do it, because he won't regret it. And I thank you, Scott, for coming on and sharing your insights. I'm sure it helped everybody. And
oh wait, there was one question from Mr. Shield. Well, Shield.
Oh, Martin. He's actually in Chicago.
Is he? Poor guy.
I don't know if he was on the floor or not, but he's in the business.
Is he?
Yep.
Well, poor guy lives in Chicago.
Yeah. I escaped.
I'm still here. It's like quicksand. It's like stepping in something nowadays with our current mayor. She's a mess. And but no, if you do the early bird special right now, the complete package is $379.
$379.05 with the discount.
Right, it's $399 plus 5% discount. It's like $379 and change. But you also get a month of pot too, which is, a huge amount of money savings too. Absolutely.
All right, Scott. Again, thanks for coming. Glenda, nice you could join us too. And I look forward to the class. Like I said, I signed up. I'm looking forward to it. And all the best, Scott. I hope everything works out with your family issues and you get to move to Maui as soon as you can.
Issues, it's the whole subscription, but but My mom is, she's just deteriorating, and there's nothing you can do about it. And
It happens.
it
Yeah.
happens, so it is what it is. It's, hopefully no one else has to go through it. So
Yeah. Well, if you're ever out in Colorado, it'd be fun to go
I'm actually
flying
going
together.
to be, I'll talk to you later about it, because I am going to go out and visit my brother.
Okay,
So
great.
I'll talk to you a bit about it later, and we'll stop by. You're still in Colorado Springs, right?
Yeah, we're about 3 miles east of the Air Force Academy.
Good. We can throw some rocks at the glass.
There we go.
I'm just kidding. Put your business cards on it. So
There we go. Easy for them to find me.
Now they know where you're at.
Yeah, they do.
Okay. Thanks a lot, Tom.
All right. Thanks, everyone. See you later.
Bye-bye.
Bye.